Hi everyone, welcome back to another exclusive podcast from IronFX, where we are dedicated to bringing you the absolute best education to help you take your trading to the next level. In today's podcast, we'll be talking about geopolitical risk and how they affect safe haven assets. Now, you may be asking yourself, what are geopolitical risks or events? Well, to put it simply, they occur at the intersection of geographical factors such as natural resources access and or proximity to countries in turmoil or that have just created a new conflict. Right. So geopolitical events can manifest themselves in many ways, and each event carries its own sets of risks, and with each risk, its own set of consequences. Over the past 18 months, we have unfortunately experienced and continue to navigate through two major geopolitical events: the Russian invasion of Ukraine in February of 2022 and the recent conflict in the Middle East that began in early October of 2023. Now, how do such events affect financial markets? Well, depending on the scale and severity of the event, it could leave either a temporary footprint or create a longer lasting impact on markets. Usually, both investors and traders seek out a path to investments and securities that are deemed as safe haven assets. Now, you may be asking yourself, well, what exactly are these assets and why are they called as such? Well, a safe haven asset is a type of investment or security that is expected to retain or increase its value during times of market turbulence or volatility. Investors and traders generally seek out safe havens in order to limit their overall exposure to losses in their portfolio during such periods of volatility. However, assets that are deemed as safe havens can vary depending on the specific nature of the geopolitical event. Thus, safe havens in one period of market volatility may react differently in another. So there is no consistent safe haven approach other than maintaining a well diversified portfolio. So, what are the typical safe haven assets? Well, they can range from precious metals such as gold to currencies to treasury bonds and as well as defensive stocks such as those in the utility, healthcare and military defense sectors. In the recent event, we have seen the negative correlation between the value of the US dollar and gold break down. Now, this occurred because both investors and traders went in search of these two securities, right? The US dollar and gold. Typically, when the value of the US dollar goes up, gold prices fall, and vice versa. This relationship is identified as a negative correlation or an inverse correlation. However, this correlation broke down as investors and traders seeked out refuge in the form of the US dollar and gold, causing a positive correlation to develop. This positive correlation will eventually fade, and the usual negative correlation between the US dollar and gold will resume. Now, how and when this normalcy will resume is anyone's guess. What is more important is to recognize and identify how certain correlation between the various securities, be it positive or negative, break down and enter a new but temporary phase so that we are able to act on such dislocations. Now, this enables us to mitigate any potential losses on our overall portfolio or trading positions. Right. So, anyways, that's all from me for today's podcast on geopolitical risks or events and how they affect safe haven assets. Do remember to subscribe to our podcast here at IronFX, where we are dedicated to bringing you the very best education to take your trading to the next level. Until then, stay safe and trade safe.